You may find this amusing, but it's actually true that an investment in fine wine is one of the lowest risk investments one can make. And I say this for various reasons. First of all, there's the demand and supply issue. As you may know, in Bordeaux, each vineyard is defined by law, which means that you cannot add 1 meter of land to a Chateau Margaux and call it Chateau Margaux. You may call it Deuxième Margaux, Joli Margaux, whatever, but you cannot call it Chateau Margaux. So therefore, if you take that supposition or fact that each vineyard is defined by law, that means that the supply itself is defined, or the supply is finite. However, it is only finite at the time of bottling. From then on, you'll open one bottle of the Chateau Margaux 2000, for instance, and that bottle will never be replaced. There will be no more Chateau Margaux 2000s created. So therefore, the supply is diminishing. In fact, it's a perfect inverse supply curve from the point of view that the greater or the longer or the more established or the older the wine is and the rarer it is, the less there is of it. That indicates that the older or more established the wine is and the more valuable it is, the less supply there is. And so on the demand side, we have an increasing growth in demand from Asia, specifically Hong Kong, where last year they reduced all the import duties for fine wine, from Korea, and from Japan. And there's also an increase in the supply or the demand for wine from non-traditional sources such as India and the Soviet Union, where they're in growth, economic growth pattern. So we have increasing demand, decreasing supply. Other reasons why this is a very low risk investment is that there is no gearing or leverage, in that the Wine Investment Fund Canada Limited takes in certain subscriptions. Whatever those subscriptions are that have been taken in are then invested in wine. That wine is held for 5 years, and then the subscription or the asset, the wines, are liquidated. So it's cash in, purchase, cash out. There's no gearing, no leverage whatsoever, and so therefore, once the asset is sold, the proceeds are distributed. And so there's no worry about banks and shorting of stocks or calling on loans or any of that sort of potential pitfall. The wines are held in bonded warehouse in the UK, and because of that, there are two very, very interesting scenarios or situations. In that, if the wines are held in bond, then the purchaser, the ultimate purchaser, assumes the risk. That means caveat emptor, where if we have purchased the wine on behalf of the Wine Investment Fund Canada Limited, if we purchased the wine in bond, we've kept it in bond, and then we sell it in bond, perhaps that wine has gone off, perhaps it's corked, perhaps it's turned to vinegar. It is not the risk of the investor or of the wine fund itself. It is only the risk, or the ultimate purchaser assumes that risk, provided that the wine was bought and sold in bond. So that is one very interesting attribute of keeping wine in the bond. The other interesting attribute is that for $1 a bottle a year, that $1 pays for storage and for insurance. And the insurance is at replacement value. So in other words, the bonded warehouse might burn down. It might be attacked by terrorists. That insurance, for less than $1 a bottle a year, pays for replacement value of all wines. So quite frankly, I can't think of another asset class where we have a situation that the class is insured at replacement value.